HomeFirst Finance. It's our privilege to be hosting today Manoj, Viswanathan and Nutan, Gaba, Patwari. Welcome Manoj, welcome Nutan.
Thank you, Saurav. Pleasure to be here.
So thank you for joining us on this Friday evening. Now, the reason we've invited you guys is we've been investing aggressively, actively, researching HomeFirst and investing aggressively in HomeFirst over the last several months. Stage has spearheaded that effort, and more generally, right? We believe that the revival in credit demand that we're seeing in the country bodes well for housing financiers. If you look at the EPFO data, we're seeing something like 1 million additions per month to the EPFO data. And this has been going on for the last 3 years, quite remarkably, even through COVID. The number of subscribers being added to EPFO are going up at a record pace, which suggests that housing financiers focused on especially the salaried segment like HomeFirst will do very well. But before we get stuck into HomeFirst, why don't I introduce our two guests for today? Manoj Viswanathan is the Managing Director and CEO of HomeFirst. He's been with the company since its incorporation. He has a bachelor's in electrical and electronics engineering from BITS Pilani and an MBA from XLRI. He's been in consumer lending for 24 years. He's done automobile lending, mortgages, unsecured lending. I think that's pretty much, I think you covered the full house there of consumer lending. And he played an important role in building Citi's branch-based consumer lending franchise. I guess that's now with the Axis Bank. So I'm sure Amitabh Chaudhary will be happily inheriting. So we've invested in Axis as well. So Manoj ka legacy work also, hopefully we will make some money off in our Axis investment. Moving on to Nutan. Nutan Gaba Patwari is the CFO of HomeFirst. She is a qualified CA. I think therefore that means we have Salil, Tej and Nutan. We've got 3 CAs on the call. She has 15 plus years of experience in finance. Before HomeFirst, she was in True North as a VP Finance with an responsibility for implementation of strategy in True North's financial services investee companies. And before that, she had been in prestigious firms, Unilever, ITC, Philip Morris. So welcome, Manoj. Welcome, Nutan. It's a privilege to be hosting you this evening. So if you could just kick off for the benefit of many of our investors are joining us, many of our customers are joining us, right? And a common question that we keep getting from both our current customers, current investors, and prospective ones is they say, "Dekho, India mein there are so many lenders. There are, I think, 10,000 lenders, NBFCs registered with RBI. There are hundreds of housing finance companies. How can a affordable housing financier actually build competitive advantage in what, at least from the outside in, looks like a very competitive sector with the big banks competing, with the HDFCs of the world competing?" So Manoj, if you could just kick off by helping us understand the nature of competitive advantage and how you guys have gone about building it.
Sure. So we set up this company in 2010, and when we started the company, affordable housing was still not really a thing. It was just it was not a buzzword at that point of time. It was something that was coming up, and probably I can introduce this particular topic by as to how we started the company. I mean, that will kind of make it a little more clear. So we started out by actually building affordable homes. We set up a venture to build affordable homes, and then we started, speaking to existing, banks and housing finance companies to finance these affordable homes. So at that time, these homes were priced between around 5 to 12 lakhs, my role was to actually sell these apartments, and so I would take prospective customers to the site, show them a sample flat, ask them about their, livelihood, and how they're going to arrange the down payment, etc. Because our sale would be complete only once the down payment comes in. So we had kind of a, very close interaction with these prospective customers, and then we would refer these customers for a loan. But there, what we found was that most of the existing players at that time, large lenders, were not very interested in financing these customers because of various reasons. One is that our main reason was that they would not tick all the boxes, right? So I'm operating with I'm an existing lender. I'm operating with a certain template in my mind that I have A, B, C, D, E, F, G are the points which need to be ticked by the customer. But unfortunately, this customer does not take all the A, B, C, D, E, F, G. He takes only A, B, C, D, right? So E, F, G is missing in some form. But it's not that he is not a genuine customer. He's coming with his down payment. He wants to buy the, he is a genuine end user. So looking at all this is how we actually, decided to set up a housing finance company. So we realized that, 9 out of 10 customers who come and want to purchase an apartment or want to build a house are genuine end users. They have the ability to repay the loan. They are very strongly emotionally attached to the property. So the chances of default are very low. And see, you have to see that we were when we started the company, we were all basically coming from a banking background. So we were evaluating all the customers from that perspective. So we realized that 9 out of 10 were if you look at it holistically, they were ticking all boxes. But because the banks were operating with a certain template, they were not able to get the loans. So that is really, and that situation has not changed even today. It's 12 years since we set up this company. Okay, it's just the size of the pie has in fact expanded. So if, let us say, at that point of time we thought maybe 3 out of 10 customers were facing this problem. Today also, probably 3 or more, 4 or 5 out of 10 customers are facing some problem in getting a loan from the larger lenders. So that is, the starting premise as to why a company like us should exist, right? So we are not actually directly head on taking on the larger banks or lenders, right? So larger banks, lenders have their own business to do, and they have enough of that business. It's there is a problem of plenty over there, right? So there are enough number of customers in this country to satisfy the growth requirement of large banks and lenders, and who are willing to tick all boxes, who come satisfying all the criteria that is laid out by the banks and lenders. And besides that, there is a huge you can say a part of the iceberg which is not seen, which is below the water, where there are customers who are struggling with various challenges and who still want to own a home, but who don't meet the requirement of the large banks and lenders,
right?
Which is the segment that we are we are going after. According to our estimate and according to the numbers from the bureau itself, this pie itself is about 2 million units every year. Right? 2 million customers every year, okay, are trying to buy or build a house in the price range of 0 to 25 lakhs in this country, and a majority of them, at least 50% of them, are facing some problem or the other. They don't get it first go, right? They're not able to walk into a bank or a large lender's office, say that here is all my documents, you can give me the loan. It's just not possible for them. At least 50% of them have some or the other flaw, some or the other shortfall in their documentation, because of which they struggle to get a loan, and that is the pie that we are going after. So we are, at a bare minimum, we are talking about a million, million units every year, right? Out of which currently our share is 2%, which is we are doing 20,000 loans a year. So which means somebody else is obviously taking away the balance, right? And that's a huge pie that is there. And if you are focused, you stick to your guns, you keep going in the same direction, you can actually take on a large part of that pie. Capture a large part of that pie.
So Manoj, if I understood you correctly, you're saying that there's a large enough pie that the big banks are not going after. That's the area you guys are focusing on, and therefore there's enough white space for you guys to do your thing for many years to come.
Correct. It's a kind of, I think the question was, how would you compete with the large bank? So I think it is a kind of indirect answer that, okay, firstly, we are not competing directly with the large bank, and we are not going after the same customer. But of course, there is some competition even in this segment, and obviously we have to, we have various competitive advantage. Probably we'll talk about it, down the line.
Sure. So folks, we have Manoj and Nutan till 7 o'clock. So please fire in your questions in the Q&A box. Tej and Salil will take as many of them as they can and put them to the folks from HomeFirst. Let's make full use of the fact that we've got a team here which has done affordable housing finance in India for 12 years. There are very few people in India who've done affordable housing finance in India for longer than a decade. And I think we're staring at a couple of them. So let's come back to the subject of competitive advantage and technology, right? So your latest annual report, delightful read, all credit to the team that put it together. Great fun to read the latest annual report. And there's lots of vignettes you guys have given about the use of technology to drive lending, to drive rapid turnaround times. Can you help us understand how you guys have thought through technology, how you've used technology to build your business to drive competitive advantage?
Sure. So let me start with, again, so because you're staring at a guy who's been in this company for 12 years, everything, all stories will start, will be 12 years old. So let me start at 2010. I mean, smartphones had still not come into the country, right? I mean, they were just starting to come into the country. So that is the backdrop in which we actually started this company. And but from day one, it was very clear in our minds that we should, and it is possible to leverage technology to on various facets of the business. I mean, to start with, we said we are going to make the customer's life easy, right? I mean, so we all came from a backdrop of working for larger companies, and also having probably gone through a loan process ourselves, a housing loan process ourselves. And we found it very cumbersome, right? I mean, so you end up dealing with multiple people in that journey. You start with, sending your requirement to somebody, then that person will pass it on to someone else, and somebody will come for a verification. And there is a period of 14-15 days when it's a complete black hole, right? I mean, you don't know what is going on with your loan. And you're just being passed around from one person to the other. So this was the backdrop in which we started, and we said we are not going to make. I mean, for our customer, this is not going to happen. I mean, he's going to know from the time he has come in as a inquiry till the time he gets his approval. It's going to be a very transparent process. He's going to know exactly what is happening with his loan. And if it is, obviously 50% of the customers would probably get declined. And so even if it's a decline, we are going to tell them upfront that it is a decline, and probably they can come to us later whenever they're eligible, etc. So this was our ideology, which we started, and which is why we use technology. It is even today, frankly, it is not required to use so much technology for a housing loan, because the first question we get asked is, a customer is very patient for a housing loan. I mean, it's a one-time purchase, right? So they can wait for 15 days, they can wait for a month. They are not going to be bothered, which is true actually, right? I mean, it's not that customers are anxious to get a loan in 2 days. That's never the case. I mean, they have a lot of patience. They are willing to wait for 15 days. But we said, if we are not able, I mean, if the customer is eligible and if he is, satisfying the requirement, you should be able to tell him in 48 hours. I mean, there's no, elaborate process that you're carrying out for 15 days that which is going to take 15 days or a month. Whatever is being done can be done in 48 hours. So that is the premise it started with. And you'll be surprised actually, from the time we started, we actually deployed what was at that time handheld scanners. So we had handheld scanners, which now has obviously gone out of work. I mean, it's like the Kodak camera. But there used to be a handheld scanner which was there in the market for about a couple of years. So all our relationship managers used to carry that. And our instruction to the relationship manager was very clear, that they cannot take any photocopy from the customer. Like, they should not take any piece of paper from the customer. Because again, one of the challenges these customers face is that they get so muddled up with paperwork, right? They are not very careful with paper, so they would have misplaced their salary slip, or they would not have all the documents. So if you tell them that, okay, you need to keep all these photocopies ready and then come to us, that itself is a big hindrance for the customer, because he gets very anxious. I don't have all these papers. I missed something, etc. So we told our relationship managers, you go and sit in the customer's house. You ask him to, show you his documents, and you scan whatever is available. I mean, if he doesn't have something, you cannot scan it, right? I mean, there is no point in telling the customer that, you bring this or that. Agar uske paas hai hi nahi, to fir, there is no point in hassling the person. Whatever he has in his home, I mean, it might be, some of them might be relevant, some of them might be not so relevant, etc. But you scan everything and you bring it, and then we will put together the story ourselves. Right? I mean, you don't expect the customer to put together the story for you. You scan whatever he has got, you capture his photographs, his videos, etc., and you bring it back and then put together the story. Okay, so he has 2 salary slips, 1 salary slip is misplaced, or he doesn't have salary slips, he's got his appointment letter. So whatever it is, you put to, scan it, on the spot, come back, upload it on your laptop, and then, put together the story. So this is how we actually started. I mean, so from day one, the ideology was that we will not take any paper from the customer. And today also, the first thing that we tell a relationship manager when he joins us is that अब पेपर नहीं लोगे कस्टमर से.
Wow.
Because this is such a strong industry practice that if you don't keep telling this every month to the team, okay, or second month you will start, they will start collecting paper from the customer, because customers themselves come with paper. They'll come with a file. Ki mera file le lo. So you have to tell them every month ki boss paper nahi loge aap. Matlab you will go and you will figure out what the customer has got. You will scan it and bring it back. So that's how we started, and the idea was that let's try and use relevant technology to make the customer's journey easy. And over time, obviously, it started also becoming meaningful from a turnaround perspective, from saving cost, from increasing the productivity of our team. So all the other benefits also started coming to us. So we suddenly realized that our relationship managers are able to do more number of loans, because he's not wasting time going back and forth and collecting documents and doing all kinds of things. One shot he goes, whatever the customer has got, he's brought it back. Uske baad, there is no point going back, because customer ke paas kuch hai hi nahi, so there's no point going to and fro. So because of it, the productivity increased of our relationship managers. So a lot of other benefits started also coming to us. So we then kept using technology as our central central driving force. And of course, when smartphones came, then the thing completely changed. It became much more easier. We were one of the earliest to adopt cloud technology, so everything was captured on the cloud and uploaded. And this also enabled us to use that centralized underwriting model. Otherwise, it's not possible to have a centralized underwriting model, because the person sitting at the center doesn't have a good sense of what's going on. So since all these videos, audios, and all can be uploaded now, and it comes to the centralized underwriter, we could use a centralized underwriting model. So then slowly technology became our DNA. So we said, whatever is, it's not the technology for the sake of technology, it's more relevant technology. So what is applicable to this customer segment, what will make sense, what will reduce cost, what will make the experience better. So it's always about picking and choosing. Otherwise, today any software company comes with a bouquet of things. Ki boss ye sab hai hamare paas, ye le lo. But that's not real. That's not our approach. Our approach is, in fact, we have our own tech team in-house. Our approach is, let's understand what is going on in the market. Let's pick and choose what is relevant for our business. So that's how we have been, using tech.
So on that subject, Manoj, one of the things that when our colleagues Tej and Keshav were conducting research on HomeFirst, one of the things we picked up was you guys seem to use SalesForce very innovatively. So what we have heard that if we go to one of your underwriting officers, we say Rajkot mein ye wala customer specific uska ye address de. You can use Salesforce to drill down right down to uska underwriting documents. How did that come about, and how useful has that been for you?
Yeah, again, it's that's a good story that I can say. So we were, so when we started, like I said, with cloud. We said we want to start with cloud technology. So we started with a small local software, which was also cloud based. And then we were exploring new emerging cloud technologies that were coming, and Salesforce at the time had made an entry in the market, and there was also a competitor, which was Zoho. So we were kind of toying between Zoho. We experimented with both Zoho and Salesforce. And then we saw Bajaj Finance using Salesforce, at the front end, for capturing leads, etc.
Yeah.
So at that time, Salesforce was still globally, it was well known for, a lead management system. It was a sales tool kind of a thing. So that's how we started. So we said initially, okay, let's use this for any lead management. So whatever leads are coming through, we will kind of track it till the time it matures into a loan, etc. So we started with that. So when we started playing, so we didn't use any vendor or anybody, right? We just got some Salesforce licenses and we started using it. So when we started using it, we realized it's got workflows in it. So we said if it's got workflows, then maybe we can use it for a credit process, because credit process is all about workflows. Right. So, the loan gets passed to one person, then the person takes a decision and it moves to the other person, etc. So we said, yeah, this platform seems to have this, so why don't we do that? So we built a small workflow and we started kind of checking it out. So our guys started using it, relationship managers started using it. They liked it. They said, everything is transparent, because, I move the case to the next guy, I can see what's going on. And all through the organization, everybody was able to kind of see what happens with a particular loan. So initially that's all we did. It was a workflow for loan approvals initially. right? Somebody, the relationship manager would log in the case, then it would come to us, we would look at it, we'll put some comment, and there'll be a verification, etc., and then we'll finally approve the loan. So this is how we started. I mean, it was a very small module. It was all developed in-house. Then we realized, everything in credit is, in lending is all workflows, right? It's disbursals, collections, everything. So then we started building on top of it, and everything was built in-house. Okay, so for example, practically the entire architecture, you can say, was put together by one of our employees, and he's currently our chief business officer. So at that time, he used to look at technology and operations, etc. So the entire architecture was put together by him, and we kept on. So there was a team of us in-house, 3-4 of us, who started understanding how the whole platform works, and we put the whole thing together. We never used any external service provider. So in a way, it's a proprietary you can say whole application that we have developed, and our teams loved it. Because I think the main thing is that people want transparency. They want to know what's going on. And so which comes out in this through this application. So whether it's a branch manager, whether it's a regional head, whether it's a relationship manager, they want to know what's going on with the loan, right? And what stage it is at and what is happening, so that they can answer the customer and business partners clearly. So everybody the team loved it. So everybody started using it. So we have nothing. Since the last 11 years, we did not have a process outside of SalesForce. Like everything that we do in the company is punched into that system, right? And people are like, if they don't have, if the Salesforce ID is not there, or if they are not able to use it for a day, it's like they are fish out of water. Abhi karna kya hai? Wow. So, it's like the Bible for the company. So everything gets captured. So indirectly, everything. So what happened was everything gets captured over there. Nothing gets left. Nothing is offline, and it everything leaves a trail. So we can clearly see what's going on. And everybody knows that everything leaves a trail, right? So they are obviously careful with the process as well. So doing the right thing and so on. So that's how this whole thing developed. And so now it's a complete ERP for us. So everything that we do, including expenses, disbursals, collections, so everything gets done on Salesforce itself. And we are probably one of the few companies which has the lending system also on Salesforce. So lending system, normally people take some other system and then they plug it in.
Yeah.
But we have a lending system also on Salesforce. So we again, we started looking at various systems. The usual suspects were all there. The ones which are developed by the large Indian companies, right? So we looked at all of that, and then we found this one company in the US which had created a lending system on Salesforce, right? So we tested it out, and we said, yeah, this is good, because it blends very well with our loan origination system. So because it will be seamless, it plugs in. You don't have to do a handoff, etc. So then we decided to plug it in. Probably I think maybe the only company in the country, or one of the very few companies in the country.
Your CIBIL, your loan underwriting, all of that plugs into Salesforce. So API bana diya aapne, using it into
and plus the loan calculation also. So typically people use Nucleus or other software, right, for loan management, for the loan loan management. So that is also on Salesforce for us.
Wow. Very innovative. No, we are big Salesforce fans, but I don't think we have quite progressed to the level of sophistication you guys have. So tremendous stuff. Let's now reflect on how this has allowed you guys to manage risk. Now, one of the things which attracted us towards HomeFirst, and one of the reasons Tej and the team ended up investing, is not only have you guys become one of the leading affordable housing financiers in terms of market share, your growth and profitability has also been very steady. So I think PAT CAGR over the last 3 years, in spite of COVID, has been 23%. And that speaks volumes for risk management. So how have you guys pulled this off? One thing to build comparative advantage through clever use of technology, but it's very difficult in India in lending generally. We've seen very few Indian lenders consistently able to deliver compounding over long periods of time. So how have you guys avoided mistakes that other lenders make?
So one is, what do you call it? The technology played some role in that, which is, like I said, it's a system or application that gives a full view of everything that is happening to everybody. So so we don't get blindsided, So typically there are blind spots, kuch handover hota hai, something enters the system, or some parts are left out of the system, some part is done on email, which is offline, etc. So here, since everything is happening on the system and everybody is looking at it, automatically it builds transparency in the whole process, right? So whether it's a new product, new project, which is being onboarded. So we are all looking at the system, we are all looking at the same system, and everything about a loan, everything about a customer, everything about the property is all captured over there. So that has definitely played a role in addressing risk. Plus, I think first 5-6 years, I mean, we were small, and I think that is a handicap in some ways. But we also built very carefully.
Right.
Right. I think we never had that. You can say anxiety to build very fast, because I think we were lucky to have patient investors. So we had Bessemer Venture Partners as venture capital investor who came in initially, and the focus in those years, the first 5-6 years, and then we had Tata Capital. So the first 5-6 years, the focus was that we should do things right. I mean, that was the focus, amongst all the stakeholders. So that, I think, helped us build good, strong systems, processes, and do things carefully. There was never, never an anxiety ki humko sab jaldi scale karna hai. And if you see our journey also, it has been a very gradual, I can say, build up. So in the first year, we had 20 crores of AUM. Today, if you say 20 crores of AUM, people will laugh. I mean, it will be considered as a completely insignificant number. Similarly, right up to third year. So I think the third year we were at about 70 crores or something like that.
Oh.
Right. So the focus was on building the systems, building the processes. So our systems and processes were far ahead of their time. I mean, so we were like a 500 crore company, but we had like systems which were like a 5,000 crore company. So that was always the focus. And again, in terms of hiring people, getting good pedigree people to the organization, running it professionally. So focus was on all of that. And even when True North came in, I think at the time our AUM was about 850 crores. So they were very clear that yes, growth is important, but we want to build it right. And so they gave us that breathing space, to kind of build things right. So, which is why there is a lot of focus on risk and addressing risk in the right way. And so there is a way of doing addressing risk, which is that, okay, put some structure in place, maker checker kind of a thing, etc. So optically it looks like risk is addressed.
Yeah.
Okay.
Yeah.
But the ideology in our company has always been that let us address the risk at the root. What is causing that in the first place, and let's eliminate that completely. Just to give you an example, so cash is, for example, in financial services, cash is a you can say starting point for many bad practices, right? So the amount of cash you collect, cash that is floating around in branches is all, it all creates all kinds of misuse. So we said this is something that we have to kill. I mean, so the least amount of cash is there, everything will become clean and transparent, right? Because if it's an electronic collection, then there is a complete trail.
Yeah.
कहाँ से पैसा आया, कहाँ जा रहा है, everything. If it's cash, then you don't know. अभी किसी का पैसा कहीं किसी और के account में भी जा सकता है. So that's, I'm saying, so focus was always that. I mean, the focus was not that, okay, you collect cash, but then you have have a maker checker. I mean, that was not the focus.
Yeah.
The focus was that cash ko hi eliminate kar do. Right. So from day one, we were always, against, collecting cash, and and now again, the instruction is very, very strict from our side to the branches that up only overdue EMIs ke liye cash collect karoge, right? Nothing else. There will be nothing else for which cash will be collected. Prepayments, for processing fee. Matlab, it is like a red flag. It pops up. Matlab, it's for any other reason, if cash is collected for whatever reason, okay, it pops up to me immediately. कि किसी branch में cash collect हुआ है. So that kind of paranoid behavior as far as cash is concerned. So I'm just giving you one example, but I'm saying, so the idea was always to kill, at a systemic level, address the risk rather than, putting in place some structure which will optically look like their risk is addressed.
Interesting. So I think before we move on to the questions from clients and folks, as I said, keep firing in those questions. We've got Manoj and Nutan till the 7 p.m. mark. Let's make the most of that. But before we go on to that, your thoughts, Manoj and Nutan, on where does the industry now stand? We had a few good years for housing finance generally in India. I think the year ending March 22 was a record year for both the residential real estate sales and for housing finance. Will the good times continue for next 2-3 years?
See, I can comment based on the comment or commentary coming in from the ground, from branches, from people, etc. The demand definitely seems to be very, very strong. I mean, it's kind of unprecedented. It's very, very strong. There's a problem of plenty. Even our guys are picking and choosing. So we have that challenge to deal with now. Because when there is so much demand, that's what happens on the ground, right? So yes, I mean, I think it's partly to do with COVID also, because I think customers have got shaken up. Everybody wants to own a home, and they feel that is a safe place, etc. So there's been a bit of a nudge that has taken place there. Plus, I think employment, etc., has come back to pre-COVID levels, and if you look at exports, etc., that is really shot through the roof, which is again a huge push on employment. So exports have crossed 400 billion, and probably it's also to do with the markets where we are present. I mean, so markets where we are present are also very strong on export. They are export-led markets like Gujarat, Tamil Nadu, etc. So which is why we are getting that commentary on the ground that there is very strong employment opportunities, people wanting houses. Demand is definitely very, very strong. We have not seen this kind of commentary coming from the ground in the last 10 years.
Absolutely, I fully agree with you.
I just thought I'll chip in a little bit here, Saurabh.
Go on, Nutan.
Yeah, so if you look at the last 25 years of data, the single biggest factor in housing demand is employment. There have been many cycles where interest rates have gone up, and the other way around. But the single biggest factor that stands out is that low unemployment or higher employment or higher industrialization indicates that, the housing demand is here to continue. Now, if you look at from what the government is trying to do with the PLI schemes, with the focus on, Make in India, etc., it only gives us more confidence that, the cycle of employment is only going to improve with the focus on the education, vocational, and everything around. This cycle seems to here to stay. And if you look at the commentary from some of the larger players across real estate, across financing, I think the momentum is exactly the same. So, you hear HDFC Limited talking about doubling the market in 5 years. And many, many such comments from the real estate in companies as well. The fact that though interest rates are rising, the demand doesn't seem to be going anywhere. So overall looks very, very robust from an analytical perspective as well.
Fantastic. I mean, we couldn't agree more with you, and we get a little perplexed when we read talk in the press about stagflation, downturn. It simply doesn't square with what we see on the ground. So sometimes I wonder which India the journalists are writing about. The one you are talking about, Nutan, seems to be the one we are also living in. So let me hand over to Tej now to take the clients' questions and put them to Nutan and to Manoj. Over to you, Tej.
So one of the questions that we've got is on this topic itself, which is around rising interest rates. What's your outlook on that? How do you see it panning out for you guys in terms of both demand, margins, and the liability side?
Sure.
Yeah, I'll just start, Nutan, and probably you can add on. So Tej, as far as rising interest rates are concerned, if you see, probably just 18-24 months back, we were at similar interest rates. I mean, 100 basis points higher, right? 150 basis points higher. And I think then we went through this whole rate reduction, and I think partly also because of COVID, there was rates were reduced, etc. Right? So we have operated in a scenario where the rates were 150 basis points higher, right? And so that's So that's something that we have seen at least a couple of times. In fact, when we started the business, the rates, prime lending rates, I mean, I still remember that HDFC's rates used to be 9 or 9.5%. And we were at, I mean, we had no clue we can lend at 13%, right? So we were quite psyched at that point of time. It was 9.5 se upar humko lend karna padega, because, you know, we are an affordable segment. So 10.5 or 11 karna padega. So, you know, those rates used to be, you know, kind of daunting for us. But I remember the prime lending rates used to be 9.5% when we started the business.
Yeah.
So rates we have seen. But having said that, you know, see, customers also, you know, the customers that we are dealing with are not, you know, buying very large ticket homes. I mean, the ticket size is 10-15 lakhs. So a 1.5% rate change, you know, means about 1,000 to 2,000 rupee difference in their EMIs, right? And if that's something that they can compensate, and even if they're not able to compensate, they generally, you can say, what do you call it? Reduce their ticket size, reduce their loan amount, right? So if they're building a house, they will compromise on something. They will say, okay, I'll take 1 lakh lesser or 2 lakhs lesser, and, you know, build that later. So that's how they will adjust. So till now, whatever we have seen last 12 years, suddenly lag raha hai ki interest rates will have an impact on demand. You know, of course, there will be noise. There will be customers who will say, you know, what is this 14%, 13% rate? You know, I should get it at lower rate. I mean, some, you know, etc. That kind of noise is always there. In fact, that noise increases when the interest rates actually go down for us. So, you know, when rates touch 6.5%, 7% is when we actually have a lot of irritated customers. When the rates are higher, that irritation level actually reduces. You know, because between a 9.5 and 13.5, the customer is still feels okay, or a 9.5 and 14.5, he still feels okay. But when the rate is 6%, we are offering 12%. Suddenly, he thinks that we are doing something, you know, which is out of whack. So, generally, that has been our experience. Nutan, anything you want to add?
I just thought maybe I'll give a thought process on the liability side, because that's also one of the aspects that Tej was trying to understand. So if you look at the borrowing book that we have, the good news is that the repo linked book is very, very small. So it's about 5% or lower. So, you know, there is no direct impact as far as the borrowing rates are concerned. Now, the transmission on the borrowing cost is a 3-step process. So first, the repo rate needs to get passed on MCLR for banks, which is where a large part of our borrowing is. And MCLR is a very competitive rate for banks. So they're also very careful in terms of transmitting fully or partially over time. It does not happen immediately. So for example, some of the private banks have only taken about 50 or 60% even today compared to the repo rate hike. The second, so that's the first part. The second part is the reset date, because most of our loans end up being a 6-month MCLR or 1-year MCLR linked loan. So it does not happen on a particular day. It happens over a period of 12 months. So to that extent, the impact is lagged. So, you know, we've done a lot of models to say, okay, what if the March 23 repo rate is 5.5%? What if the March 23 repo rate is 6%? So we've seen broadly, in a very, very broad range, is that between now, so let's say March, our cost of borrowing was 7.2%. In the worst case, it goes to 8% in March 23. In a base case, it's probably around 770, 780. So, you know, which is essentially, let's say, another 60-70 basis points repo increase from here. So we are looking at that and, you know, then the next question that comes up is, how does this impact spreads for us? And, you know, what is the eventual impact on profitability, at least in the near term? So our business model works at a 5 to 5.25% spread. Now we've been holding on to this 5.5, 5.6% spread last few quarters, even this quarter now. So from that perspective, there is a good room of around 30-40 basis points in that itself. And anything else we will pass on. And we will lead that. We won't be, you know, waiting for entire thing to come on and then pass on. And like Manoj mentioned, the stress on growth from that perspective, if we pass on, isn't looking anything like that. So that's how, you know, we're looking at it overall.
Got it. One question that we've got, this is a question from Somnath. It's around, how do you acquire clients? What's the main source of client acquisition? And can you quantify what is the cost of client acquisition?
Yeah, sure. So client acquisition, we, about 70% of it comes through connectors, 30% comes through various other channels, like builders, our branch, activities which are done by the branch walk-ins, digital marketing, etc. So 30% comes through those. 70% comes through through the connector network. So connectors are typically people like brokers, local real estate agents, contractors, chartered accountants, people like that. So they come across. They have a network of local, or rather a good local network where they have been in that locality for a long time. They know people. And generally, if somebody is looking to build or buy a house, they would kind of approach them, ask them, do you know any references? So that is their, value add. And so they refer these customers to us. We basically ask them only for the name and number of the customer. We don't, so our model is not that, these people put together a file or anything of that sort. So that is never the case with us. So we take the name and number, and then our team follows up with the customer, for the loan. So that's the model. So this is the connector model. And we feel that, if you want to be a large national player, you need to have this, you can say, local connect in the market. I mean, it's like any other product where, people sell through dealer network or a retailer network. So this is really our retailer network. I mean, it is our equivalent of our Kirana store. So somebody who has a connect in the local market with about 400, 500 customers, from that 500 customer base, anybody who wants to take a loan, he comes to know about it and he refers them to us. So that is our model. And so we are investing in building up this model. We feel that currently we have, you can say, total repository of about 10 to 15,000 connectors. Since these connectors are not professional, most of them are not professional, loan agents. They are not productive every month. So whenever they get a customer, they will refer to us. So generally their productivity is, once a month, once in 2 months, etc. So out of the 10,000, let us say, connectors who are enrolled with us, in a quarter, only about 2,000 will be active. Active means they have referred a loan in that quarter, right? So our aim is to take both those numbers up. I mean, take the 10,000 to maybe 20, 25,000 in the medium term, and take the 2,000 to, let's say, 3,000 in the medium term. So which means, in a quarter, at least one connector will, out of the 3,000 will give us, each connector out of the 3,000 will give us at least one loan. So that is the logic that we are working towards. So which will, it's equivalent, like I said, it's equivalent of any other distribution model where the more number of retailers you have, the more products you're able to sell in the market. So that is our model. Again, we are using tech there to, kind of build up this. So the whole enrollment process for a connector, we have made it very easy. It is an app-based enrollment. So they download an app from the Google Store. They can enroll themselves in about 10-15 minutes. Then they can start logging in cases on the app itself. They get full transparency in terms of what is the status of the loan. So whether it is approved, disbursed, what is the disbursal level, what is the payout they want, etc. So connectors are happy to use the app and refer customers to us, and we want to kind of evangelize this more and enroll more connectors. So this is going to be our distribution model. There are other distribution, like I said, other channels also, but none of them are as significant or as large as the connector one.
Right. A couple of questions from Bhavin Damania. He asks, which are the geographies which have the highest potential of affordable housing finance? And if you could tell us about your geographical presence or your geographical expansion plans, how you're thinking about expanding geographically. And if you could throw some light on your customer profile, especially say self-employed versus salaried, so on and so forth.
Okay. See, we have been depending on bureau data in the bureau for data on affordable housing. So affordable housing, we have kind of taken it as loans between 0 to 25 lakhs and housing loans between 0 to 25 lakhs. And so we have plotted out the number of such loans in various markets. So according to the bureau data, Gujarat and Maharashtra are the largest markets for affordable housing. So 0 to 25 lakhs. So both are almost similar in size. About I would say 25,000 crores a year would be the size of the market in these two markets. Then followed by Andhra and Telangana put together is almost equivalent to Gujarat in terms of size. So that would come in the third size in terms of size. Then you have UP and then Tamil Nadu. right? So these are the largest markets which are booking loans in the 0 to 25 lakh range today, as per the bureau. So out of these, we are very strong in Gujarat. So we have about 4% market share there, which is our highest market share across states. If you look at so 4% market share in Gujarat, and in other states we have between 1 to 2%. So Maharashtra, Andhra, Telangana, Tamil Nadu, etc. UP, we don't have a strong presence. I mean, we have kind of, you can say, ignored or left it for the time being. The reason is that UP, it's a large market, but it's a very fragmented market. If you want to have a reasonable share there, you need to be present in entire UP, including rural areas, etc. So we feel, that's not something we want to do right now. So we are concentrating on Gujarat, Maharashtra, Andhra, Telangana, Tamil Nadu, and Karnataka for the next 2 to 3 years. We feel that by that time, UP also will probably become more urbanized, and then it will be more meaningful for us to enter UP. And if you, so I've given you, I've given you the statistics. So really, what we have seen is that this affordable housing market develops in urbanized and industrialized states, which is why Gujarat is a large market, Tamil Nadu is a large market, Maharashtra is a large market. So these are, I think, two factors that drive affordable housing. Because if you see Gujarat, a lot of the affordable housing demand comes from migrants, right? So people who have come from Rajasthan, Bihar, UP, Orissa. So either they are working in the textile market or in other industries, chemical industries, etc. They have migrated, and they eventually want to settle down. And so the first few years they live on rent, then they decide to buy a house. So that's where the demand is coming from. So which is why I think these states are all have developed or have a more well-developed affordable housing market. And I think that is going to happen in Rajasthan and UP as well, as the urbanization increases and industrialization increases. So that's really the trend that we are seeing, and we are strong in the western and southern states at the moment. We want to go deep in those states. So we have presence. So currently we have presence across 200 cities in the country, across 12 states, and we want to take that to about 400 in the next 2 to 3 years. 400 cities, but this will be again all the large affordable housing markets. So we are not moving too much into the eastern side of the country. Eastern side of the country is very fragmented. It's also very small in terms of size of affordable housing market.
Right. A question from Himanshu, and I'll club it with a question from Siddharth. They ask, are there any cross-sell opportunities in this business? And the second question is, do you see any sort of repeat users? Do you track that, given that it's a high ticket size purchase? It's likely that unlike other unsecured businesses, you would see any repeat users over here.
So there is some opportunity for topping up the customer. Once he builds the equity in the property, and let's say price goes up and his loan goes down. But I would not put too much weightage behind that, because typically a house, a home loan customer is a risk-averse customer, and a debt-averse customer. I mean, he's not the kind of person who will go and take a lot of loans, and typically personal loans, etc. Right? So in fact, they want to pay off their loan fast. So while we, top up is an opportunity, but I don't think many customers are going to opt for that. It will be a very limited kind of an opportunity. Repeat purchase, again, I would not put my money on that, because we are dealing with an affordable housing customer who will eventually get upgraded, right? So if he's coming back, which means his whole status in life has also changed, right? He has probably become more formal. He has probably become more fluent. He would then go to his own bank to take a housing loan. He would not come back to us. So this is our position right now, but things could change. I mean, we are, of course, we are trying. It's not that we're not trying. So we feel the opportunity is there in top up loans and providing other loans to the customer. But I think we have to make that process easy, because customers typically they compartmentalize in their mind. I mean, for them, housing loan means okay, HomeFirst or HDFC, or they have their brands cut out in their mind. And if it is a consumer durable loan, they will say Bajaj, right? So in their mind, it's already compartmentalized. I mean, for them, it is like, suddenly consumer durable loan from HomeFirst nahi samajh mein aata hai type of thing, right? So for that, you need to make the whole process easy. So we are trying to do it on the app which the customer is using, make it in a form of 1 or 2 clicks, so that, when he walks into a store, if he wants to purchase, he could probably, take the loan from us. But still, we would not put too much weightage behind it.
Right. Question from Raj Kataria saying, what would be the share of balance transfers in and out? And link it to a question from Archit Maria. He asks, how will you retain the customers? Are you trying to do anything to build and sustain customer loyalty, given that it's a competitive market?
Yeah, so let me give the numbers first. So, the outgoing, the balance transfers outgoing is about 5% annualized. So 5% of our customers are moving out. Incoming is about 1% of our AUM, or 1% of our disbursals. So how do we try to retain? Is one is that we have developed some analytics, so we kind of can predict who's likely to kind of move out. So we try to do some interventions with them, and from a service perspective, etc., and engaging the customer more. Plus, we also, there's a very strong counseling process when the customer comes to us for a balance transfer. We offer them top-ups, etc. So that process is on, and I guess which is why that number is still at the 4-5% mark. And we will keep on intensifying our efforts there.
Right. Question from Keyur Parikh saying, does a fully direct sourcing model work better, given that some of your competitors are doing a fully direct sourcing model versus say connector-based sourcing model? And I'll link it to the type of or the method of underwriting as well, centralized versus a combination of centralized and decentralized.
Sure. So let me address both, because these are things which we have debated so many times, in our journey. So there were many times when we kind of thought, yes, we should have a proprietary workforce and SalesForce on the ground, etc. But then over time, we've realized that the churn and front-end workforce is so high that whatever value you build keeps on evaporating every 2 or 3 years. Right. So if you hire 100 people, as your own sales force, and you put them on the ground, you train them to acquire new customers, etc. But that those 100 people have left you in the next 3 years, right? Because the churn is high in that set of in that group. So then, what really is the franchise? What is the value? In a long term. So that question, we kept asking. So we realized that, it's probably better to build a dealer network. Even if you take probably a very random example, but if you take Hindustan Lever, I think their franchise value or the value of the company is because they have 6 million retailers or whatever it is, right? Who are selling their product and who are used to selling their product. They are not going to say that, oh, I have 2,000 sales executives, who are my own executives. So that's the thought which keeps coming back to us, that you need to have something permanently on the ground who is your distributor. He may not be exclusive. Just like any other retailer of any other product, he's not going to be exclusive, but there will be a quasi-exclusivity which comes over a period of time, right? Over time, they, get used to selling your product. They start liking your company. There's some loyalty which builds up. You do certain things for them. And it's just the way you treat them, etc. Right? So over time, the loyalty gets built up. So which is what we have now putting our money behind, building a strong distribution network on the ground, a connected network. And this has been done in the past. If you see Grow Finance, that entire model was built on this whole referral agent network, and they are very loyal people. Today also, they swear by Grow Finance. So which is what we want to build, and which is what we are going after. Sorry, your second question was on
underwriting model, centralized.
Yeah, underwriting, centralized versus So there again, so many debates around this. Initially, when we started, and when so much of technology was not there, it was all about, okay, local flavor here. There's a local guy who has to take the call, etc. But it both has its pros and cons. So for example, local guy, then you need to have that many number of local people who are so good at underwriting and whom you're able to again retain, right? I mean, so if you're talking about 400 cities, to handle 400 cities, you need at least 200 underwriters on the ground. If he is a local underwriter, so 200 underwriters, it's not that this underwriter is a different type of human being. Who same front end employee hai, where the churn is 20-30%, right? So then every 3 years again you're replacing this entire team. So then what quality are you going to get out of it? So all of these are the questions that trouble us when it comes to local underwriting. So which is why we said, let us keep it centralized, because the centralized underwriting team, it's a smaller group, you can nurture it and curate it very well. Usme churn zero hai. Like in our centralized underwriting team, this is zero churn in the last 5 years. Zero. Not a single person has left us. So and you cannot achieve that on the ground, right? And plus it's more scalable, right? So today you can open any location and you know that okay, kal se underwrite kar sakte hain. Whereas if you're going with a local underwriting model, then you have to find a suitable person there. Then there is always a crib from the market ki boss wo banda matlab hafte mein ek baar hi aata hai, he's sitting in the nearest large market. So all of these challenges, so which is why we decided to kind of really put our weight behind centralized underwriting, and it has really helped us. It's helping us to scale now very rapidly, because you can open locations without thinking ki boss kal se kaun underwrite karne wala, right? And the wealth of information that these guys have, because they are with us for so long, and they have seen so many different markets. They have a bird's eye view. That wealth is difficult to recreate on the ground.
Right. Question from Namit Mehta. Affordable housing or just housing finance in general is a competitive market. Why do you think most players in this business build or create something which generates say 13-14% ROEs? Why do you think you can generate or build a business which generates ROEs over cost of equity?
Yeah, I think so. This is I think boils down to the fact that there are I think still India is a low middle income country, and there's a long journey, maybe 10, 20, 30 years, when customers are going to come into this net of affordable housing, right? I mean, so probably today they are below the poverty line. Tomorrow they are going to come to an affordable housing level. So it's a long runway, and there are many different challenges to solve. Many different challenges to solve, and as you keep solving those problems for customers, there is a premium that you can earn, for solving those problems. So that is the perspective that we are going with. That I mean, it's not. I mean, we will not deal with it like a commodity or a commodity product. I mean, we're not going to look at it like a commodity product. We are going to keep on solving some new problems. I mean, so today, I mean, for last 10, 12 years, it was about, how to underwrite an informal customer. Maybe next 5 years, it will be about how to do, co-lending in a great way. After that, it will be about, how to, I mean, you discover some new segment and you address that. So you have to be, you can say nimble to kind of look at what are the new emerging opportunities and, capitalize on that.
Okay, great. Over to you. Back to you, Saurabh.
Thanks, guys. Thanks, Nutan. Thanks, Manoj. This has been a lot of fun. You built a very interesting, very impressive business, and I love the way Nutan helped explain the reality on the ground. I hope those who are listening take away the reality that yes, jobs are being created in the country, especially in that belt which you guys highlighted: Gujarat, Maharashtra, Karnataka, Telangana, Andhra, Tamil Nadu. The economy is in actually pretty good shape, and we've invested in HomeFirst. We hope to make good returns for our clients from it, and we wish both of you the very best as you continue growing this fabulous franchise. Thank you very much for joining us, Manoj and Nutan. We'll hand back to now Tej. Manoj and Nutan, you can, if you want to listen, you can listen in. If you want to log off, feel free to do so. Tej will now take clients through the portfolio where we are with returns in the portfolio. So in a way now, the mirror turns on Tej. The spotlight goes on him. He has to now explain to clients how much money he's making for them. And then, as ever, folks, feel free to put questions in for Tej. Salil will take those questions and put them to Tej over the next half an hour or so. Thanks,
Thank
Manoj.
you,
Yeah, thank you, Saurabh, thank you,
Thank you.
Tej, thank you, Salil.
Thank you.
Yeah,
Thank you.
bye.
What do you, Tej?
Yes. So first of all, looking at the fundamentals of the portfolio, and this is zooming into the recent most quarter. This is Q4 FY22 for the lenders in our portfolio. If you look at growth, this is loan book growth for the lenders for the quarter, sequential loan book growth. Whether you look at the largest lender, HDFC Bank, largest private sector bank in India, that's actually grown at the fastest rate. Similarly, second largest NBFC in India, Bajaj Finance, again grown at the fastest rate within the portfolio, 9% sequential growth for both of them. Or you look at HomeFirst Finance, who explained how good the housing situation is on the ground, which is the smallest lender in our portfolio in terms of AUM size. They've also grown at 8% in terms of sequential loan book growth. So we are seeing quite a broad-based growth within the lenders in our portfolio. They're grown at about 29% annualized during the quarter. And this is coming on the back of a couple of things which help the lenders, especially specifically in our portfolio, which is, first of all, they do not have any historical baggage on the balance sheet in terms of NPAs or NPA recognition. Quite clean balance sheet, well provided for. Second, they also have a lot of access to liquidity, enough access to tier 1 capital to capitalize on the demand on the ground. And versus that, if you look at the industry growth numbers, industry is growing at just about 2.5% sequentially, which is 10% annualized. Versus that, the lenders in this portfolio are growing at almost 3x that pace. So 29% loan book growth for the lenders in our portfolio versus just about 10% growth for the industry. And the industry consists of 60% of the industry consists of PSU lenders who have structural issues in terms of capital allocation, in terms of conflicts on where to allocate capital, in terms of management bandwidth, access to capital and liquidity, given that most of the PSU lenders are sitting at 10, 12, 13% tier 1 versus 18 to 25% for most of the lenders in the KCP portfolio. So versus competition, actually the portfolio is actually pretty well positioned, as you could see from the massive market share gains that the portfolio is seeing quarter after quarter. And we expect this sort of growth to continue. So while 10% is the number for the quarter, as we speak, loan book growth for the industry itself has inched up to 13%. So we believe that loan book growth for the lenders in our portfolio should only accelerate from here on. Now zooming out to the past 5 or 6 years on say similar metrics, if you look at loan book growth for the lenders in the portfolio over the past 6 years, before COVID, it used to be around the 25% mark. During COVID, it did dip a bit, given there were a few quarters when we went through a lockdown. Obviously, lenders could not lend then. And then for a couple of quarters, the lenders in our portfolio were intentionally conservative in terms of their lending outlook, given the uncertainties around. However, if you look at FY20 numbers for the year as a whole, we're back to 20% plus growth, loan book growth for the lenders in our portfolio. Across the years, loan book growth for the KCP lenders has been significantly higher than the bank nifty. Similarly, on the asset quality on gross NPAs as well, it's not that the lenders have been growing at breakneck speed without taking into account risk. The gross NPA numbers have been between the 2 to 2.5% mark. Versus say 4 to 5% for the bank nifty. Even during COVID and the past 5 years, we've seen multiple macro headwinds, whether it be IL&FS crisis, DHFL, Yes Bank, 2 waves of COVID. Even through that, the gross NPA numbers have been between this range of 2 to 2.5%. And as a result of this, the ROEs for the KCP portfolio are significantly higher. Along with this, the leverage for the portfolio is almost half that of the bank Nifty. So these institutions are leveraged less, have lower NPAs and grow faster. And despite the lower leverage, the ROEs for these companies is significantly higher. So despite the lower leverage, they are at about 17-18% ROEs if we also add the non-lenders in there. As we see loan book growth further accelerate, and these companies utilize the excess capital on their balance sheets, the ROEs will further get pumped up. So we expect that ROEs from here on, loan book growth from here on, will only improve. As we speak, obviously asset quality is in pristine shape for these lenders and only improving quarter after quarter. Discussing the fundamentals of these lenders, we wanted to highlight a couple of important points, which is around how different lenders have a different approach to compounding book value per share. So it's a combination of organic ROE growth and book value compounding through the organic return on equity minus whatever they pay out as dividends. And on top of that, because these lenders have high reinvestment rates, they're also able to raise capital. And that is where the low cost of equity for these lenders, or the high price to book multiple, put in another way, the high price to book multiple further adds to book value compounding for high quality lenders like a HDFC, Kotak, or a Bajaj Finance. And to put things into context, if we look at the reinvestment rates, which are at the bottom of the screen, in the table at the bottom of the screen, the reinvestment rates for high quality lenders is around the 100% mark, in excess of 100% for a Kotak Bank or a Bajaj Finance. The reason that they are able to do this is they are able to allocate large sums of capital at high return on equity without making mistakes, without substantial NPAs, and then they are able to raise large amounts of capital at high price to book multiples. So this in turn becomes a virtuous cycle where high quality lenders are able to generate high ROE and also are able to accentuate that ROE acceleration by growing their book value per share by raising capital at high price to book multiples. And this is the last 10-year history, where you can see that across cycles, whether it's 2012 to 14, where we're hearing currently about taper tantrum, similar situation then, whether it be 2014 to 17 during the asset quality review, or whether it be during the past 5 years, these companies have been able to raise capital across cycles and then deploy it successfully at high ROEs, consistently high ROEs for these companies. And during this time, while the lending sector went through lots of ups and downs, these companies had asset quality under control, as is evident by their high return on equity numbers. So this is the business model: deploy large sums of capital, extremely high reinvestment rates, and therefore the market trusts them. They're able to raise money from the market at good price to book multiples, further delivering better book value per share compounding. Coming to the KCP portfolio performance, is the latest performance. We launched in July 2020. Since then, we've delivered 6.5% compounding versus a much higher number for the bank Nifty. And like we've explained before, as you can see, the fundamentals are actually looking very good for the portfolio. The portfolio fundamentals through this time have held up quite well. However, the bank Nifty consists of 5 banks, SBI and ICICI, which we don't own currently, plus Axis, HDFC, and Kotak. And SBI through this time period has more than doubled, and it's about 15% of the bank Nifty. And we've seen what SBI has done over the past 10 years. Over the past 10 years, SBI has not been able to deliver more than 14-15% ROE for even a single year. And it remains sort of a cyclical story, given the challenges of being a PSU bank. And that is the largest source of underperformance. Obviously, in addition to that, there is ICICI Bank, which we don't own. However, we remain focused on the fundamentals, and the outlook on growth, asset quality, ROEs for the lenders in our portfolio remains quite robust.
Great. Thanks, Tej. We'll take some questions now on clients. So, a couple of related questions on the fact that can diversified NBFCs take market share away from dedicated housing finance companies, especially, let's say, within the portfolio, we have a Bajaj and a Chola versus an Aavas and a HomeFirst. How do you see them playing out in terms of competitive dynamics?
Sure. So, say a Bajaj Finance or a Chola are focused on different parts of the market. A Bajaj Finance does have a housing loan book. However, it is competing with the likes of HDFC Limited, where it would compete at within the prime mortgage segment, and it will be lending at rates which will be similar to HDFC Limited, which will be around, say, currently around the 7.5% mark. Versus that, affordable housing is a specialized skill set where a HomeFirst or an Aavas are lending at 13, 14, 15%, and the average ticket sizes are around, say, 10 lakh rupees. Whereas the average ticket size for a Bajaj Finance would be around, say, 35, 40 lakh rupees. Also, given the challenge that Manoj and Nutan were explaining of templatizing the process of affordable housing, that is not something that the banks have been able to do. Similarly, that is not something that Bajaj Finance or Bajaj Housing Finance would be interested in. Given that they want to scale, they are able to raise capital at low cost. They're able to raise debt at low cost. They want to scale, and they want to scale in the prime lending market, which is lending at 7.5-8% with absolutely zero risk and extremely low NPAs. That is the model, and that is the segment that a Bajaj Finance, Bajaj Housing Finance would be focusing on, versus a completely different segment, which, like Manoj explained, is the 0 to 25 lakh rupee ticket size segment that a HomeFirst or an Aavas is present in.
Thanks. So, folks, put in your questions for Tej related to the KCP in the Q&A box, and Tej will attempt to answer all of them. Tej, the next question, this is specifically in case of Aavas, but it would be nice if you can tell us how does rising interest rates impact portfolio in general, and is there a differential between how, say, the larger lenders get impacted versus NBFCs?
This is specific to Aavas. Is that what you said, sir?
It is specific to Aavas, but I'm assuming that there will be people wanting to know in general what the questions are on, what the impact is on the portfolio as a whole.
Sure. So Aavas makes about 5.5% margins on its loans, and before COVID, it used to make about 5% margins. As we see the rising interest rate environment, as we see interest rates rise further over the next 6 months or a year, we believe Aavas is well positioned to handle that. First of all, we'll be going back to rates which were anyways existent before COVID. Currently, we are still well below pre-COVID levels when it comes to the repo rate. So first of all, these companies have anyways done well even before COVID, when rates were much higher. Secondly, Aavas's liability profile is well diversified. It borrows from about 32 different organizations, banks, and DFIs. Secondly, the mix of variable loans and fixed rate loans on the liability side, and the mix of variable and fixed rate loans on the asset side for Aavas financiers is completely matched. Thirdly, there is no sort of ALM mismatch. Aavas is sitting on 3,000 crores of surplus liquidity for FY23, and for each and every bucket, there is no mismatch when it comes to ALM. So Aavas is actually quite well positioned given the completely matched nature in terms of fixed versus variable, and in terms of tenure on the asset and liability side of its balance sheet. Similarly, as we have highlighted in one of our recent newsletters, the large banks are actually beneficiaries of a rising interest rate environment, given that HDFC, Kotak, Axis have a good liability franchise. They have a high CASA ratio. Kotak, say, for example, is at 60%. HDFC and Axis are in the mid-40s when it comes to the CASA ratio. So as the cost of money rises, as we see increase in repo rates, The CASA ratio will help protect these companies actually their margins, and they'll actually help improve their margins over the next year or so, because current accounts are priced at 0%, and the rate on savings accounts does not increase at the same rate as the repo rate will increase at. And that creates actually a good differential in terms of the rates that these companies lend at, that these banks lend at, and the rate at which that they are able to raise deposits. So that margin had actually been under pressure in a low interest rate environment. However, the strength of the CASA franchise will now show through fully for these banks.
Thanks. Okay, here's an interesting question from Siddharth Chawla. He said that Bajaj Finance is already a $45 million company. And what is the opportunity size that it has to grow? And can it become $1 trillion company in the next 10, 15 years? And essentially, I think what he's trying to say is that gap on what size can Bajaj Finance grow to?
So to put things into context, the lending market, and this is just loans from banks in India, is loans outstanding from banks in India today is about 120 lakh crores. HDFC Bank of that is 12-13 lakh crores. SBI is 25 lakh crores. So even HDFC Bank, largest private sector bank, and that too only within the banking sector, has only a 10% market share. On top of this, if we add to it the NBFC market, if we add to it other informal sources of lending, the market size further increases to at least about 170 to 180 lakh crores. And on top of that, this market is growing at 12-13% as we speak. So 180 lakh crore market, out of which Bajaj Finance today is 2 lakh crores. And SBI, for example, despite all of the challenges of a PSU lender, is growing a 25 lakh crore balance sheet at 10%, which is 2.5 lakh crores. So SBI is easily adding a Kotak Bank to itself every year. HDFC Bank, in the recent most quarter, the numbers, the quarter numbers are on the screen. It grew at 9% sequentially. It added about 1.1 lakh crores to its balance sheet in 3 months' time in the recent most quarter. And Bajaj Finance's size is about 2 lakh crores. So it's adding about half of Bajaj Finance every quarter. SBI is adding Kotak Bank to itself every year. And despite all of this, HDFC Bank has only a 7-8% market share of the overall lending industry. Bajaj Finance has about a 1.5-2% market share of the overall lending industry. So scope to grow is huge. Competitive intensity, given the nature of competition in India being largely PSUs, even within the private sector, multiple banks struggling with issues of their own. Similarly, multiple NBFCs lack the technology that Manoj spoke about, lack management bandwidth, lack infrastructure, capital, etc. There are a handful of companies which are well positioned, well capitalized to capitalize on this opportunity of the lending space in India. And the names on the screen are actually well geared for this opportunity.
Great. There are a lot of questions related to housing finance. I guess that's because of the HomeFirst management was earlier here. The stage of question is, and I think it's a follow-up from what you said already about the large NBFCs versus HFCs. Would you say there is a similar differential between some of the smaller rural or semi-urban NBFCs, like say Sundaram or Mahindra? Will they have any competitive, or will HFCs in the portfolio have any competitive edge over some of the smaller NBFCs who only are targeting similar market segment?
Right. So there are different NBFCs focusing on different parts of the market. Say, for example, let's take the couple of names that are there in the question. Say Sundaram Finance. Sundaram Finance largely competes in the vehicle financing segment. And that too, it competes in the segment where the risk is absolutely zero. I mean, they compete with banks. Sundaram Finance is an organization which is extremely conservative, risk averse, and they would be lending to, say, large fleet operators, where banks are also present. On the other hand, say Cholamandalam is also a vehicle financer, but they would be lending to fleet operators which are smaller in size. We will not be lending to fleet operators that are Sundaram Finance or the large banks would be lending to. They will be lending to a different part of the market where collections, infrastructure, where underwriting plays a big role, and you need to manage your risk, manage your NPA as well. And they are able to charge also 13, 14, 15% for that versus the 10, 11, 12% that the Sundaram Finance would charge. Similarly for Shriram Transport. Shriram Transport lends in the riskiest segment of vehicle finance. It would lend to largely used vehicle fleet operators where used vehicles are being bought. And the lending rates for that would be 17, 18, 19%. And NPS on that would also be 7, 8%. So different models where different NBFCs have built expertise. And similarly, in the context of housing finance, Cholamandalam might do housing, Sundaram Finance also might do housing, but Sundaram Finance, just like in the vehicle finance segment, would do housing only in tier 1 cities and would again compete with banks. Similarly, Cholamandalam would do housing, but would do it in, say, tier 2 cities. And Shriram might do housing, say, in tier 3, tier 4 towns. It actually does have an affordable housing finance sort of arm, which does housing, which is similar to HomeFirst, but with significantly higher NPS. We believe that HomeFirst or Navas, which is a specialized player focused on one part of housing finance, is a significantly better play than someone like Shriram, who's doing housing finance in the same markets, but has significantly higher NPS. Salil, you're in mute.
So, thanks, Dave. So one related question in the same vein is that in a lot of our communication from Marcellus' side is that we are educated to invest in market leaders. Would you say that any of these HFCs, because they're all focusing on such niche segments, some are in tier 1 cities, some are not, and so on, would they qualify as market leaders? And if not, then why invest in them as opposed to what we generally advocate people to do?
Yeah, fair question. So given the size of the market, right, even HDFC Bank, in that sense, will not be a market leader, given that it has only, say, a 7-8% market share overall. Similarly, when it comes to affordable housing, there are largely 3 or 4 niche players who are operating in this segment. The names being Aavas, Aadhar, Aptus, and HomeFirst. And then there are a host of other small players who are trying to build a presence in this segment. Out of these 4 players, Aavas and Aadhar are the largest, followed by HomeFirst and Aptus. And given the size of the opportunity, given that these are the players who've built an expertise in this niche segment, having even a, say, 4-5% market share, that Manoj spoke about, that they have in, say, Gujarat, or Aavas having 5-6% market share in Rajasthan, that is equivalent in this space to, say, HDFC Bank having a 7-8% market share overall in the lending market. And that is why, given the long runway for growth, given the high profitability that these companies can enjoy over long periods of time, it makes sense to invest in these companies. They are at the forefront of affordable housing, despite having only, say, a 3-4% market share.
Right. Then there's one question on just asking for your thoughts on small finance banks. Do you think there are interesting names out there which qualify for a KCP?
So most small finance banks, apart from AU, have their the original business model was unsecured MFI lending, microfinance. And most microfinanciers then applied for a small finance bank license between 2014 to 2016, and then got that SFB license. And given that original business model, large part of their book continued to be unsecured till 2018, 2019. And then over the past 2-3 years, they've tried to move to a more secured loan book, given the inherent cyclicality and challenges that a microfinance lender faces. And given this nature of business, which is MFI, and given the origins of these businesses, we believe that it's extremely challenging for these SFBs to build a business model which on the asset side is able to, where they are able to lend to people and build a secured business, where historically they've had no evidence, where we've seen no evidence of them having any sort of competitive advantage in building a secured business. They also don't have any experience of building a secured business, and all they've done for 10 years, 20 years is build a MFI book. And on the liability side, along with the challenge on the asset side, also build a CASA franchise, also build a liability franchise, where they are competing with the likes of HDFC, Kotak, Axis. So that is an inherent challenge in the small finance SFB sort of business model, with the cyclicality on the asset side and competing for deposits on the liability side with the large banks.
Yeah, I hope that clarifies. And then we have a question from Rama Basappa, and he says there's been a fair amount of churn in the KCP portfolio. So can you shed some light on this?
So we, in the past year and a half, would have made three or four exits. And part of it is, and most of them were small positions in the portfolio. The exits being, say, DCB Bank, City Union Bank, 3.5% to 4% of the portfolio. Similarly, HDFC, MC or AU, all of them were about 3.5% to 4% of the portfolio. And we've made exits for a couple of reasons. One is, say, HomeFirst Finance, which is the recent most entry within the portfolio. We believe, as you can see on the screen, we believe that it can deliver, say, 25 to 30% annualized loan book growth for the foreseeable future. And the prospects of a HomeFirst Finance, therefore, in our scoring model, which includes growth rates and longevity, were better than some of the existing companies in the portfolio. Similarly, say, when we got in Chola, we replaced City Union Bank with Chola. We believe Chola can grow at 20, 21, 22%. City Union Bank, being a more conservative lender, can grow only at, say, 14, 15%. And that is the sort of, those are the sort of changes, and that is the nature of changes that we've made in the portfolio. But we're cognizant of this fact that it should remain a low churn portfolio. Annualized churn in terms of percentage would still be not more than 6-7%.
That helps. Thanks. Vishesh Gupta asks that we discuss now the opportunity set in India, how things are panning out well. So the growth picture looks pretty good. But are there any headwinds or risks that you would want to keep a watch out for?
Yeah, especially in financial services, there's always various types of risks which can come about, and uncertainty is definitely part of any cycle. So the counter to that, rather than predicting any of these risks or predicting, say, macro risks, the counter to that is to invest in lenders which have high amounts of capital. We can see, sorry, yeah. The counter to that is to invest in lenders which have high amounts of capital. As you can see on this slide, row number 5, leverage for the companies that we have invested in is almost half that of the companies in the Bank Nifty. So invest in companies which have large capital buffers, so that in case any of the risks emerge, in case anything goes wrong, capital can, there's enough cushion when it comes to capital to absorb those risks. Secondly, these should be companies which are always cognizant of risks, and they should not do lending just on the basis of the current cycle. They should price in risks which are cross-cyclical risks, and that is evident in the second row on this table, which is gross NPS. Across FY 17 to 22, where we've seen various types of risks, right? Different types of risks which have emerged over the past 5 or 6 years, which is demonetization, which is, say, government policy risk, which is, say, ILFS crisis, which is a specific sector-specific risk where specific bad actors cropped up and increase the risk for the NBFC sector, specifically ILFS, DHFL, Yes Bank, or whether it be COVID, which is, say, macro or a healthcare risk. different types of risks emerged, but the gross NPA number for the companies remained in the 2 to 2.5% sort of narrow band. And that is the counter to any sort of risks which can emerge, rather than predicting any specific risk. Which is invest in companies with lower leverage, excess capital, and which are risk averse just in general, irrespective of whether the macro is looking good or bad.
All right, great. Unfortunately, folks, we have run out of time, so that was the last question we could take. Thank you, Tej, very much. Thanks, Saurabh.
Thanks.
Thank you. Have a good evening also. And a good weekend.
Bye.
Thank you.